Hello, as part of our ongoing legal guide for startups video series, I'm going to talk about fundraising. Now, fundraising is understandably an area of particular focus for a lot of businesses. Sometimes I feel that some startups are a bit too focused on fundraising, but on the other hand, if you don't have resources to build your product, market your product, hire employees and so on, then it's very difficult for a business to be successful. So I can understand why people are pretty focused on getting funds in for their business. Now, the main sources of early stage financing for most startups are self-funding, friends and family funding, and angel investment. And I'll talk about those in this video. There are some options available, which I won't discuss in detail, but which may also be available, like the government-backed startup loan scheme or bank financing, which will be available in some cases, although often a bank will be looking for security, which can make it difficult for early stage businesses which don't have a lot of assets to raise finance from lenders. So the main source, the most common source of very early stage financing is self-funding, where a founder puts some money into their own business. And a founder can put money into their business either by way of a loan, they lend money to the company that they've set up, or by way of equity, they buy some shares in the company. And in the case of Gina and our startup Streamzer, she's decided she wants to put a bit of money into the company to pay for some initial expenses. How should she do that? Well, given that Gina has started the company and owns all of the equity in it, or the vast majority of the equity in the company, there isn't much point in her buying more shares. And so, as with the vast majority of startups, we would recommend that Gina lend the money to the company. That has another advantage, and it allows Gina to draw down that loan and have it repaid by the company later on, and that will not attract any tax. Now, often when investors invest, if a founder has lent money to the company, the investors would say, well, look, you have to wait 2, 3, 4 years before you can repay that loan to yourself. We don't want our money that we're investing in the company just to be used to repay you. I'm going to talk a bit about some of the terminology used in fundraising. There's a lot of jargon. It can sometimes get a bit intimidating. So first of all, what's a round? Well, a round doesn't really have a scientific or technical definition. It generally refers to a series of investments that are made at around the same time, at around the same price or valuation. And usually it's the difference in valuation, hopefully a steady increase in valuation, which distinguishes one round to another. And so what are seed rounds, angel rounds and series rounds? Well, a seed round is usually the first set of investments that a company takes. An angel round means investments by business angels, that is individuals who are investing their own funds. And a series round usually refers to an investment round where institutions or businesses are investing. And that could either be funds, venture capital or other funds, or it could mean strategic investors who have a commercial interest in the business. And the first series round, the first round where institutions are playing a part, is usually called the Series A round. The second is called the Series B round, and so on. Okay, so what types of investment are made at the early stage if we've got a group of investors who want to invest? Well, the simplest kind of investment is that the investors buy shares in the company. And I'll talk about that in a bit more detail later. But there are a couple of other options. One other option is a convertible loan agreement or convertible loan note. That is a loan to the company, which normally has an interest rate and is repayable on a certain date. But the difference between a convertible loan and a normal loan is that it is usually convertible into shares on certain events happening. The most important event at which conversion occurs is usually a fundraising the issuing of shares to equity investors at some point in the future. And when that happens, the convertible loan, the funds that are lent, are in effect repaid to the lender by issuing shares to them. There's also a variation on that called an advance subscription agreement, or SAFE in American sort of parlance. The simple agreement for future equity, that's an acronym for. And a SAFE or advanced subscription agreement is an agreement under which funds are put into a company, but they're not turned into shares immediately. Instead, there's a period, and if at the end of that period a fundraising has not occurred, the investment will be converted into shares at a default valuation. If there is a fundraising before that end deadline date, then the shares would usually, the investment would convert into shares at a discount to the price paid by those investors. And under a convertible loan or an advanced subscription, there's usually a cap, a maximum valuation above which the investors won't have to suffer conversion. And that protects investors who are investing via a convertible loan or an advanced subscription from the company taking off like a rocket ship and then ending up with a very small percentage. So for the remainder of this video, I'm going to talk about a standard seed round. That is an investment for shares in the company by a group of investors. And I'm going to assume that our clients, Gina and Streamzer, are raising funds from a mixture of angel investors and friends and family. Now, some of the investors have told Gina they would like to claim SEIS relief on the investment. So what does that mean? Well, the Seed Enterprise Investment Scheme, SEIS, and the Enterprise Investment Scheme, EIS, are specifically designed to incentivise UK tax residents to invest in UK startups. There are a number of tax benefits that investors will benefit from. The benefits are not really for the company, they're more for the investors, but they do make the investment more attractive. And they include an income tax relief when the investment goes in, and capital gains tax relief when the shares are eventually sold. I'm not going to talk about SEIS or EIS in much detail at all. There are a few points to bear in mind. There are time limits. There are maximum amounts that can be invested via SEIS and EIS. There are rules that have to be followed. The business has to be a trading business. And it's worthwhile checking those rules carefully because you can be tripped up quite easily with SEIS and EIS. So let's assume for these purposes that SEIS is available to the investors. What happens in terms of how are terms agreed with the investors? Well, Gina and Streamzer will need to agree some kind of document usually which summarises the terms. And that's usually called a term sheet or heads of terms. And that's a 1, 2, 3 page document usually which summarises the core terms of the investment and what will eventually go into the investment agreement and other documents. Once that term sheet has been agreed, it's usually over to the company's lawyers to prepare the documents. Sometimes if there is a lead investor, their lawyers would prepare the documents, but at a seed stage, it is usually the company's lawyers that prepare the agreements. I'm just going to talk quickly about valuation because this is often a cause of some confusion. Because obviously one of the main things that will be set out in that term sheet is the valuation at which the investment is being made. So when someone makes an equity investment, they are buying newly issued shares from the company. It's quite rare for shares to be purchased from existing shareholders. The percentage shareholding that an investor receives after their investment has been made will be based on the amount they're investing and the valuation. And you do need to distinguish between pre-money valuations and post-money valuations. A pre-money valuation is the value of the company before the investment funds have gone in. A post-money valuation is the pre-money valuation plus the investment. So the post-money valuation is what's the value of the company, taking into account its value beforehand, before the investment took place, and the funds that are now sitting in the company's account from the investors. If you add those two together, that's the post-money valuation. To calculate the percentage that investor receives, and this is the key point, it's their investment as a percentage of the post-money valuation. It's not their investment as a percentage of the pre-money valuation. So, for example, if a company is being invested in by investors who are investing £100,000 at a pre-money valuation of £400,000, the investors will receive 20% of the shares in the company. So you take the £400,000 pre-money valuation, you add their £100,000 investment, so the total is £500,000. Their percentage is their investment, £100,000, over the post-money valuation, £500,000, equals 20%. It is not 25%. So often people get confused here because they divide the amount being invested by the pre-money valuation, so 100 over 400, and they end up with 25%. So very important to keep those two concepts separate, the pre-money and the post-money valuation. So before the investment closes, the investors have said they'd like to do some due diligence. That just means some investigations into the company, asking some questions, asking to see some documents, and so on. There often isn't much to investigate. In this case, Gina and Streamzer, they've only been going a very short time. There isn't actually much for the investor to have a look at, but they do just want to check a few things, have a look at a couple of contracts, check some financials. So that's a process that usually happens after the term sheet has been signed. So what are some of the most common terms that investors look for? In this case, what have the investors put in the term sheet that Gina and Streamzer have had to accept? So the first one is the investors are looking for an investor representative on the board. They've asked for an observer. An observer will attend board meetings but won't have the formal decision-making power of a director. They could have asked to put a director on the board, and having an investor director on the board after a fundraising is relatively common. However, an investor director does have all the responsibilities as well as the powers of a director. So for that reason, often observers are used instead of formal directors. The investors have asked for information rights, and on a quarterly basis, Streamzer will have to give the investors information about the company's financials, any recent hires, and other key information. There's also a list of reserved matters. Those are consent rights, things that the company cannot do unless they've got the consent of a given majority of the investors. In this case, it's 51% of the investors who have to consent for those key decisions to take place. So they may be things like more fundraising, hiring very expensive staff, taking on borrowings, opening overseas branches, those kinds of things. If the company wants to do those things, it needs to get a majority of the investors on board. The investors have also asked our founder, Gina, to sign non-compete covenants, agreeing not to compete with the business while she's there and for a period after she's left. They've also asked Gina to lock in her equity for a period. So in this case, she has to lock in her equity for 3 years, and her equity is reverse vested over that period. That means that if she leaves after 18 months, she effectively loses half of her shares. And that's just a way to sort of keep her locked in and building value for the investors. And the founder and the company have also asked to give warranties, that is, contractual promises about the company when the investment is made. For instance, that the company is not involved in any litigation or disputes. And there are various other warranties. And those warranties are subject to limitations. So Gina's liability is pretty low. She's only liable up to her annual salary, but the company is liable up to the amount invested. Next step, we're going to talk about recruiting the team, taking on employees and contractors. Thank you.